You've probably heard of Realty Income, right? They're famously known as the monthly dividend company. And let me tell you, their latest performance report, it tells a really fascinating story. It's not just about collecting rent checks. Nope. We're talking about some serious global growth and a pretty powerful tech advantage they've got up their sleeve.
All right, so let's get right into it. We're going to break down their official Q3 earnings release. And look, we're not just going to stare at a bunch of big numbers. We're going to try to understand the strategy behind them. What's really driving this company forward? That's what we want to find out.
Okay, so first things first, before we dive into the nitty-gritty of the results, let's just get a quick handle on who Realty Income actually is. Because trust me, understanding their sheer size, it's absolutely central to their whole game plan. So their entire business model is built around this thing called a net lease. And what that means, in simple terms, is that the tenant, the business that's actually in the building, they're the ones responsible for most of the expenses like taxes, insurance, maintenance. It kind of makes Realty Income less of a typical landlord and more like a financing partner. And the result? A super steady, really predictable stream of income for them.
And when we talk about scale, wow, the numbers are just staggering. They own over 15,500 properties. Just let that number sink in for a second.
So who's renting all these places? Well, we're talking about more than 1,600 different clients. I mean, it could be anything from the corner grocery store you pop into every week, all the way up to these massive industrial logistics companies. And get this, that client base is spread across 92 different industries. Now, that's not by accident. It's a key part of their strategy. This kind of diversification is meant to make them resilient, so they can do well no matter what the economy is throwing at them.
Okay, so now that we know who we're dealing with, this huge, diversified real estate giant, how they actually do this past quarter. Let's check out the scorecard.
All right, you can see right away the key numbers here are up compared to last year. Now we're going to focus on that second one, AFFO. That stands for Adjusted Funds from Operations. But really, you can just think of it as the actual cash profit they're making. It's the money they have to reinvest. And, you guessed it, pay out those famous monthly dividends.
Okay, now this number right here, this tells a huge story. A rent recapture rate of over 103%. What that means is when a lease was up for renewal, they didn't just re-rent the space, they re-rented it for 3.5% more money. I mean, that's a powerful sign that their properties are in high demand.
So, things are looking pretty solid with their existing portfolio, right? But for a company this big, you always have to be looking for the next source of growth. And for them, a huge part of that story is happening across the Atlantic in Europe.
Yeah, this chart really says it all. In just this one quarter, a massive 72% of their new investments, we're talking about $1 billion, was poured into Europe. That completely dwarfs what they spent in the US.
So that begs the obvious question, right? Why Europe? Why such a huge push there, especially when their home base has always been the US? Well, lucky for us, the CEO, Sumit Roy, he broke it down pretty clearly. He basically said that right now, Europe just looks like a better deal. Why? Well, for a few key reasons. The competition isn't as fierce, the potential market is actually bigger, and, this is a big one, it's cheaper for them to borrow money over there right now.
And this really shows you what that strategy looks like in practice. Think about it. The US market is getting pretty crowded. You've got these huge private equity players like Blackstone and BlackRock moving in. But in Europe, the landscape is much more fragmented. It's like a wide open playing field for a company with their kind of scale to come in and really make a mark.
But their growth isn't just about geography. It's not just about where they're buying. They've also got a kind of secret sauce, a technological edge that they've been working on for years.
So, for the past 6 years, they've been building out their own custom AI tool, and it touches literally every part of their business. It helps them find new properties to buy, it helps them figure out the financial risks, it guides them in lease negotiations, it even helps them decide when it's the right time to sell a property. It's the whole shebang.
And here's the really cool part. This isn't some static program. The CEO made it super clear that this thing is constantly learning. Every quarter, the model makes a prediction, they see what actually happens, and if there's a difference, the model learns from it. It gets smarter and smarter over time. And that's not just a cool tech feature, it's a real competitive advantage. It's how they get to those incredible numbers we saw earlier, like that rent recapture rate.
So, you add it all up, a strong quarter, this massive push into Europe, and this AI-powered brain running in the background. What does that all mean for the future? Well, let's take a look at their updated forecast for the rest of the year.
Okay, so they're actually bumping up how much they plan to invest this year by $500 million. And they've also narrowed the range for their profit forecast. Now, when a company does that, it's basically a big signal of confidence. They feel really good about their strategy and how things are going to play out for the rest of the year.
Which kind of leaves us with one big final thought. When you look at Realty Income's story this quarter, it really feels like it might be showing us a new playbook for winning in real estate. As competition just keeps getting tougher, maybe the old mantra of location, location, location isn't enough anymore. Is the future of this industry really all about combining global scale with an AI-powered brain?